Hey everyone, welcome back to the channel. I'm Doug, the retirement guy, and today I'm going to answer a few questions that people have been asking me on the YouTube chats and also on our Patreon. The bear market. Okay, we have a bear market that people are talking about, a lot of experts are talking about, and we could see anywhere between a 10%, 20%, up to a 40% drop off in the marketplaces. So everyone's been asking, Doug, what do you do to protect your portfolio? What are you going to set up with? And it's interesting as they asked this question, and I've been doing this research prior to that, and I said, well, this is going to be a perfect timing for this. And I come up with this as what we call income that survived every recession. I have 10 funds that keep paying all the way through. I went way back to 2008 and the housing crisis, 2019, the COVID periods we went through. Recessions are going to happen, guys. Income shouldn't stop. And these 10 funds will pretty much target a yield between 7 to 12% return. So it's reliable income that you can count on, and it's dependable. It pays in almost any economy. So let's get deeper into these 10 funds to see if A, do you hold them, or B, are they even interesting to what you have going on? Now, an important disclaimer before we have to go on, this content is for educational and entertainment purposes only. It's not financial advice, and the presenter is not a financial advisor. Investing involves risk. Income is not guaranteed. Past performance do not guarantee future results. Hey, before we jump into the video, I got to do a shout out. You guys have been phenomenal with our coffee mugs. We're almost trying a hard time trying to stay on top of the orders. But thank you so much for supporting the channel. And this is how we do this. We don't sit down and look for people, to advertise on our channel, because I want to keep this as straightforward and biased as possible. So you want to help the channel. You don't want to join Patreon. I understand that right here. Hit the QR code, look the link down below. We can easily get you a beautiful 11-ounce coffee mug for only $8.99 plus shipping. This helps support the channel, and it's a beautiful retirement made easy mug. You'd be comfortable having it. Just want to put that out there. Our coffee mugs are still available and ready to ship. So on March 20th, the fastest bear market ever, we had a 34% drop in the S&P 500 in only 33 days. Now, some investors barely noticed and others panicked and went nuts. So which side of the fence do you really want to be? Do you want to be the guy panicking, watching the numbers just drop off, drop all the way down? Or do you want to be the disciplined, the volatility person that can sit back and is calm and staying focused on what's going on? So there's three paths people normally take when something like this happens. One, they put cash on the sidelines. They don't know what to do. They don't know what to buy. They're afraid of things happening. And that hesitation misses opportunities left and right. I have some people that just basically put some money in a little savings account. They're waiting until the market gets right. And we never know when the market's right. So we're going to, they got cash on the sideline and you're losing money on that side of it. They ride out the drop. I've seen this many times. And personally, I've done this one. It's tough now. Stronger later, that you sit there and just watch. Will it come back? When will it come back? Sit and just waiting. And now you're trying to multiply a lower number to get back to your higher number. And then number three is getting paid. And for 10 years now, I've been retired. I've been through the 2019 crisis, didn't flinch. Getting paid, income on a regular basis, the dividends, the monthly income, cash flow, that winning path is the one that we're all looking for. And selecting the right funds can make the difference in between 1, 2, or 3. So really, again, who do you want to be? Number 1, cash on the sidelines. Number 2, riding it out. Or number 3, getting regular paychecks on a regular basis and enjoying life. So the first funds we're going to talk about are going to be utility. These are going to be closed-end funds. Now, people don't stop paying their electric bills, okay? So the electric companies are going to continue to get money. They're going to get the lights on, And electric, think about electric. Everything runs electric nowadays. Your electricity, your AC units, your heating units. There's so much that goes on, and it's a steady demand. So our first fund that we're going to talk about is DNP, the Select Income Fund. Now this one has a current yield of about 7%. Monthly distribution since 1997, nearly 30 years without cutting the payout. Look at this line. It's just point blank, 0.065 cents per share. Steady Eddie all the way across the board. This is what I've always asked for in a particular funds. I just want this across the board. Now I want to be greedy a little bit. I'd like to see an increase. We all like to see a little pay increase, but these guys have kept it right along there, keeping about 7%. Now since the max, now this fund, like I said, this always goes back to 1988. The maximum is about 7.06% in growth. Now you see the markets up, down, all the way through, but the dividends always stayed the same. So if this is for an investor who wants that consistency above all else, a check that arrives every month exactly the same, month in, month out, no worries, no questions. It's almost like forget about how much I put into it. How much am I getting at 6.5 cents per share? Our next fund, the Cohen and Stearns Infrastructure Fund, UTF. Again, another 7%. This one is designed for utilities, communications, infrastructure, energy, and industries. Has never yet cut a dividend. Distributions have never been cut, and look at the numbers they've actually had. What I asked for is a raise in the dividends. Now this one I put a track history out there about past 5 years, okay? Or I'd have the screen bigger and bigger. So this one here over the past 5 years is zero cuts with just the latest increase over the last 30 days. Now this one here again came out 2005. It's investors who want to participate in cash flow with a slightly different flavor from pure utilities. Okay, so someone may come back and say, oh, no, I'm not doing utilities. Well, here's one that mixes it up a little bit. It gives you utilities, some communication, infrastructure, energy, and so on. Now, this one's had a 37.13% maximum growth side of it. So I'm trying to show you that we do have some funds that do have some, steady, they have some good growth, but mostly we're looking at these distributions so that we're getting regular money in on a regular, I'll call it every month type application. Now, some core thesis and a wider exposure is what UTF gives you. Our next one is growth alongside the income. So a lower yield today, higher yield tomorrow. This one right now, if we bought today, is about 5.6 to 6% yield, depending on which day you buy. It's had 13 raises since inception. Okay, and we're not just talking, a couple of, we'll go up a penny here and a penny there, but they start multiplying across the board. Distributions since 2004 have paid out $1.8 billion. Okay, so that as we continue to say, as it continues to grow and grow and grow, those distributions, they rise. Here's the other thing we look at, and this is something I always tell people to look at, the total return. Okay, take a look at the total return of this thing. The maximum, okay, the maximum all the way out on this fund is 10.85% average. So if we're taking a look at when we originally bought it, you're talking 5.5 to 6% is what the yield's coming in. So that's giving you about another 5% of growth. 10 years, 9.95. 5 years, 10.6. Past year, 18.48. And the year to date so far, 12.24. So the whole utility thing is kicking in. And why do I bring this up? Because what is the number one growth out there? And that's technology. And what's happening in technology? They're building data centers. What do data centers need? Everyone complains about it. Everyone loves it. Data centers coming into our neighborhood. Then they turn around and hate it because they have to pay the electricity. And they need those utilities. And that's what this fund's all about. Now, master limited partnerships. Now, this is a fee-based infrastructure. It's based on volume, not oil prices. It's a big thing people get mixed up with. This is about I always call it the infrastructure of what we're talking about. Okay, this is how much oil we can pump through, not the price of oil. It's getting it from point A to point B. Okay, it's the infrastructure today and the income for tomorrow. The first one, the gold standard in MLP safety, and that is Enterprise Products Partners, EPD. It's one of the largest distribution growth streaks in this space. 27 years of pure growth. Okay, you can just see every few months the bump, 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 and they continue to raise this thing. Essentially, every year the company has been publicly traded, they've had an increase in growth of their distributions. Okay, this one survived the commodity crashes, it survived the 2008 crashes, it survived the COVID pandemic, because no matter what, we need electricity. We need to move oil around to get it to where we need to be. We need it in our cars. We need it in production. We need it all over the place. So this is the cornerstone MLP holding with the annual raises that consistently keep pace with or exceed the inflation. I give you the total returns on this one, 13.96% since its maximum put out. 9.8% 10 years, 16.28 5-year average, and then 23.58 over the past year. Year to date, it's already up 17.29% year to date total return. So again, another fund that we're looking at is the secure and lock in. Now, we're not talking huge yields already. 7% has been the highest. Right now we're at 5.8. Remember, this is all about consistency. It's consistency that I'm getting that check no matter what happens out in the world's economy. Now, the high yield and active growth. Now, that's always rare. And MPLX is the one that's going to kick into this one. 7.4 to 7.6 current yield. There's been 0 distribution cuts in the 13-year history, plus a 12.2% raise the 2 years running. So they're not cutting their distributions. They haven't done anything with that distributions. What they have done is they've actually raised it here in the past 2 years. Now, a 7% yield with double-digit growth guidance, that's what we're really talking about. So again, if we take a look at the current year-to-date, 11%. 1 year, 20.76%. Take away that 7%, you're talking about a 13% growth. 5-year average is 24.24. So actually last year was a off year because we're off 4%. 10 years, 15.83. Investors that are comfortable with a K1 at tax time in exchange for some strongest growth and trajectories on the list, this is your fund. Now, I know K1s can be a tough one to do. And I'll be honest with you. If you don't know what a K1 is, I'll put it in the layman's terms. I always try to put it, and that is basically do your taxes twice. K1s are a pain in the butt to do, and maybe they're not for everybody. And I'll tell you that up front. It's not for everyone. But it's well worth when you're getting big growth with a nice yield. Now, Pimco, fixed income closed-end funds. This is somewhere I got this question from a few other people as well, is that they always like these fixed income funds. Diversified income, global reach, and reliable returns. Now, Pimco has basically 3 different types of funds. There is corporate bonds, mortgage securities, and those international debts. This one gives you that monthly income, the professional management, and it's built really for retirees. I mean, there is no question about it. This thing's built for retirees. But we always have to say investment involves risk, and closed-end funds may trade at a discount to the NAV. So the past performance are not guarantee our future results. I've said that many times, but we got to be safe and secure. These things may be something that we're going to buy and hold and never even worry about. This may go into our, seriously, may go into our foundation funds, maybe into our growth funds, but this is where we're going to buy it and set and forget. So we're going to start off with 2 Pimco fixed income funds. These are double-digit year tiers. The first one, PTY, the Corporate and Income Opportunity Fund. The current yield right now, 12%. So that's huge. Now you look at this thing, pretty much I call it the flat line again. It does have a little bump in January. Didn't do it in 25 this year. It all depends on what happens throughout. But it's a diversified investment grade and high yield corporate mortgage debt. It's payable durable during the 2-decade levels. Now here's the problem we run into, and this is why I always tell you guys, you got to check your total returns. If we go back to the maximum period, it's up 10.9% on average. 10 years, 8.82. 5 years, it's down to 0.25%. Okay? So this is where we start getting into a little bit of question marks. 1 year, it's down 2.77%. So that 12% is actually only at 10% because of that 2% drop off in total returns. So this one also year to date so far is down negative 0.50. This past month up 3.32. So this is one of those, again, that you're buying this not for growth. You're not looking for anything other than income, stability. But I always got a question, is it a yield trap? Where does it sit? And over the past, basically 5 years, the Corporate and Income Opportunity Fund has struggled to get its growth to keep its yield. But it's still one of these things, long-term, big picture, things look great. I think we're in a bad period here, but proves exactly what I started the whole conversation with. A fund that is giving you double-digit yield, but still basically keeping a head above water. Now, our second fund is PCN. Again, look at the line. Identical line setup. Now this one does corporate and income strategy fund. It's not going to get in the mortgages. It's really getting the corporate side of it. It's held up a lot better in the total returns. I personally like this one better than the other fund. 11.7% yield, which is 11.25 cents per share a month for 23 plus years. There's been no cuts in the regular distribution. And we look at the total returns, you're looking at everything in the positive except right now year to date. Okay, we still have 6 months to go before getting it to the final finish. And we're going to be, I believe, across the board, staying positive in this situation. So PCN, that corporate income strategy, to me is another one of those great, strong, double-digit yield tier items that pay no matter what goes on in today's market. So as we get things rolling, will they pick back up? Yeah, because back 10 years ago, things were doing a lot better than when we were today, especially in the corporate side of it. Now, I gave you a fund earlier. A fund that started in 1929. Okay, what happened back then? I'll give everyone who's not old enough yet. The Wall Street crash. October 24th of 1929, we had the biggest drop off at the time of the Dow Jones. Now, this one has paid dividends for 97 years. Even through the depression I talked about, through everything that we've had since 1929, this is one particular fund that has done it its entire life. That fund, ADX, the Adams Diversified Equity Fund, has targeted a yield between 7 to 10% annual income. It's a diversified equity portfolio. It focuses on total returns. It's actively managed and it's built for investors and retirees. This thing just has a proven track record since 1929. So I break this one down for you. Look at what we have done. Okay. I'm not going to tell you that they've had any cuts. I actually look at them and say they've had some little boosts. Okay, because of what they do. Okay, you got to look at this. This is more of a quarterly payer that just switched more to the monthly paying side. So when you see these little dips, that just doesn't say that they quit paying. It means it's a quarterly situation broken down on a scale by monthly. Now we're paying out on a regular basis. This fund has a $3.15 billion market value. Okay. It has 122 million shares outstanding, and it pays a dividend of about $1.85 or 7.20% currently. This is a very inexpensive fund. After 5 years, I took this thing to 5 years to give you a realistic number of 28% growth. So we're getting growth plus we're getting dividend yield. Very strong piece. And when you take a look at that, since 1929, the fund's been paying out. You can't beat that. So what do you think about these particularly? Match the fund to your goal. You want pure stability, that same check each and every month. That's what DMP will give you. Stability with a growth component, and that's UTG and EPD. And then you want the high current yield and some growth, and you're okay with a K1 form. That's the MPLX. Now, if you want a diversified recession-resistant income, blend one, 2 and 3 together. So you're going to have that. You're getting the magic growth with some income across the board. Okay, these are the things how you build a portfolio to make sure you're comfortable and moving forward if the bear market really comes in, hits hard. So a check every month changes that whole philosophy of investing. Okay, I just talked about these 10 funds that I personally found. I did research on them, found it all the way through. Let me know in comments below which one works for you. Which one are you giving them maybe a second thought to? Maybe you're looking at ADX, that 1929 fund. But then again, maybe it's utilities, maybe it's the pipelines. Let me know your thoughts. Just kind of give me an idea where you guys are sitting, if this answered a lot of your questions out there. And is this something that you'd like to put in your portfolio? It's not going to be the high income, but it's going to be that consistency that you do. It's kind of like that insurance policy that you buy. Let me know in the comments below. And most important, don't forget about our Retirement Made Easy coffee mugs. We're ready to get them out to you. This is what helps support the channel. Thanks, guys, and we'll catch you next time.